Two guys, same age, 27, same city, same income, both making around $58,000 a year. Both opened a brokerage account for the first time in the same week, March 2009. Both started with $5,000. Both had read the same advice about investing young. And both were terrified. The market had already collapsed 57%. Unemployment was heading toward 10%. Every headline looked like the world was breaking. CNBC was practically using the word crisis as its logo. One of them looked at that environment and said, "This is insane." He moved to cash and waited for stability. The other did something much harder. He kept investing. $500 a month. He kept buying through the panic. He kept going when things got worse. By 2020, the first guy had roughly $18,000. The second had over $210,000. Same age, same salary, same starting point. Completely different result. And the difference came down to one short window when fear was at its highest. That's it. Not genius, not luck, not secret information. Just behavior during panic. And right now, we may be in that kind of window again. Because if you've turned on the news lately, you've felt it. That specific kind of financial dread where you feel like you should be scared, even if you're not fully sure what to do with that fear. Here's the situation. In the source script, oil was around $72 a barrel before the conflict escalation. By the end of March, Brent crude had hit $118. That is a 63% spike in a single month. One of the biggest monthly moves in decades. The market reacted the way markets always react to uncertainty. It panicked. The S&P 500 had its worst quarter since 2022, down 4.6%. The Nasdaq fell more than 10% from its highs. Microsoft was down more than 20% year-to-date. Tesla more than 21%. The VIX, Wall Street's fear gauge, nearly doubled, moving from the mid-teens to over 35. CNN's Fear and Greed Index fell into extreme fear territory, around 8 to 17, levels that the script says showed up on just 3.4% of trading days since 2011. That matters because when fear gets that extreme, most people stop acting like investors and start acting like they're trying to survive. The media tells them to panic. Their instincts tell them to wait. And history tells a different story. Now, before we talk about the opportunity, we need to be honest about the fear, because the bear case sounds real for a reason. Oil spikes. Higher energy costs push up the price of transportation, manufacturing, food, and everything that depends on them. If inflation rises again, the Fed cannot cut rates as easily as investors hoped. If inflation stays sticky, rates stay higher for longer. Higher rates slow growth. Slower growth combined with inflation brings up the worst word in macroeconomics: stagflation. That is the bear case. And I'm not going to tell you it's impossible. But possible and probable are not the same thing. That distinction is everything. Because people keep comparing moments like this to the 1970s, but the conditions underneath are completely different. In the mid-1970s, inflation was running above 10% and climbing toward 14.5%. Unemployment hit 9%. GDP was contracting. The U.S. was heavily dependent on foreign oil. Wage structures were feeding inflation back into itself. It took brutal rate hikes and years of pain to break that cycle. The setup in the source script today looks different. Inflation, 2.7%. Unemployment, 4.2%. GDP, still positive. The U.S. is now one of the world's largest oil producers. Productivity growth is running above 4% annually, largely driven by AI adoption in the script's framing. These are not cosmetic differences. These are structural differences. That's why the script argues the probability of stagflation is elevated, somewhere around 20 to 40%, but not the base case. Fear is real. A decade-long structural disaster is a much bigger claim. And markets do something dangerous in moments like this. They start pricing the worst emotional story, not just the most likely one. That's why opportunities like this exist. Because if the market has already priced in a severe outcome, and reality turns out less bad than feared, prices don't gently drift upward. They reprice fast. History makes this point painfully clear. RBC Wealth Management analyzed 20 major military conflicts since 1950: Korea, Vietnam, the Gulf War, Iraq, Russia-Ukraine. Across those conflicts, the average S&P 500 decline was about 6%. The market bottomed in an average of 13 trading days and recovered in an average of 28 trading days, less than 6 weeks from fear to recovery. Think about how insane that is. Most people are still waiting for clarity at day 28. They are still watching the news, still telling themselves they are being prudent. And meanwhile, the market has often already moved. That is how wealth gets missed. Not because people are stupid. Because they wait for emotional permission after price has already moved. The script gives more examples. When Iraq invaded Kuwait in 1990, oil spiked and the S&P 500 fell 15.9%, then gained 29% in the year after the war ended. When the Iraq War began in 2003, the Dow rose 2.3% on the day of invasion, and the S&P gained 26.7% over the next 12 months. Even during World War II, the Dow gained about 50% from 1939 to 1945. Wars feel catastrophic. Markets often recover much faster than human psychology does. Zoom out even more, and the pattern becomes even harder to ignore. Over the last 100 years, the average bull market lasted 4.9 years and returned 177%. The average bear market lasted 1.5 years and declined 35%. Over rolling 10-year periods, the market produced positive returns 94.1% of the time. Over rolling 20-year periods, the source script claims the record is 100%. Every single one. Including periods with world wars, depressions, oil shocks, and financial crises. That changes the question. The question is not whether moments like this feel terrible. Of course they do. The real question is what those moments have historically meant for disciplined investors. And that's where this gets uncomfortable. Because the greatest opportunities almost never look like opportunities in real time. They look like mistakes. Go back to March 2009. The market was down 57%. Banks were failing. GM was going bankrupt. Serious people were openly talking about structural collapse. Now imagine a completely ordinary person investing $500 a month into Amazon from March 2009 through the end of 2019. Total invested, $60,000. The value of that position today in the source script, roughly $2.3 million. That is not a genius story. That is a discipline story. The company numbers from the script are staggering. Amazon bottomed around $1.75 split adjusted in 2009, and later reached around $210, roughly a 120 times return. Microsoft went from about $15 to $383, around 25 times. Apple bottomed near $2.79 split adjusted and delivered around 90 times. Even the S&P 500 itself went from about 676 to roughly 6,500, nearly a 10 times move in under 15 years. These were not speculative lottery tickets. They were dominant businesses bought during maximum fear. That is the point. And according to the source material, fear is again discounting major businesses today. Microsoft down 20.5% year to date. Amazon down nearly 9%. Meta down more than 8%. Businesses with scale, moats, earnings power, and long-term dominance available at prices that did not exist months earlier. So, if the data is that clear, why do most people still get it wrong? Because information is not the problem. Behavior is. March 23, 2020 is the clean example. The S&P bottomed at around 2,237. COVID was spreading. Economies were shutting down. Financial media was openly questioning whether markets would fully recover. Millions of investors sold and waited for certainty. By August, about 5 months later, the S&P was back at all-time highs. From that March low, the market later tripled. The people who sold did not just avoid pain, they missed the recovery. And this happens because human beings are wired for loss aversion. In the research cited in the script, losing $1 feels roughly twice as painful as gaining $1 feels good. So when red numbers show up and headlines turn dark, your nervous system pushes you toward escape. That is why average investors consistently underperform the market. The script cites Dalbar's long-term data. Over the 30 years ending in 2015, the S&P 500 returned 10.35% annually, while the average equity investor captured just 3.66%. That is a 6.69 percentage point gap every single year, compounded for decades. JP Morgan data in the script makes it even more painful. $10,000 fully invested over 20 years grew to $64,844. Miss just the 10 best trading days, and you are left with about $29,708. Miss 30 of the best days, and you barely beat inflation. And 76% of the market's best days happen during bear markets or the first 2 months of a new bull market. Read that again. The days that create the most wealth happen during the periods when fear is highest. So if you are out of the market, you do not get them. You cannot go back and buy those days later. That's why this framework is not about prediction. It is about positioning. First, the script argues that at least 40 to 50% of investable money should sit in a broad S&P 500 ETF, like SPY or VOO. Why? Because this is the vehicle that, in the source framing, has produced positive returns in every 20-year period on record. It is the simplest way to own the long-term engine of corporate America. Second, layer high-quality individual companies on top. Durable models, dominant positions, businesses whose earnings do not depend on one specific geopolitical outcome. Microsoft, Amazon, Meta, Google. The script also suggests mid-caps may offer even larger dislocations where fundamentals have changed far less than prices imply. Third, and this is the one that decides everything, keep investing through the bad months. Every month. And if your plan allows it, invest more when things get uglier. Because the math changes in your favor when prices fall. If the market drops 30%, your monthly contribution buys 43% more shares. If it drops 40%, your money buys roughly 67% more shares. Downturns do not just create pain. They create discounted ownership for anyone still accumulating. The script references analysis of the 2007 to 2014 cycle, showing that consistent monthly investors captured a 66.6% return, while investors who doubled contributions when markets fell more than 5% earned 83.9%. Panic sellers got cash yields that were close to nothing. There is one more layer that matters. When the rest of the world gets unstable, money does not disappear. It flows. And according to the source material, over 60% of global foreign exchange reserves are held in US dollars, while the Treasury market sits at around $24 trillion. During global stress, capital often flows toward dollar-denominated assets because there is nowhere else large enough and liquid enough to absorb it. That means global chaos and U.S. market collapse are not the same thing. The source also cites Goldman Sachs with a year-end S&P target of 7,600, roughly 16% above where the script frames current levels, while noting healthy private sector balance sheets across households, corporations, and banks. No obvious subprime-style bomb. No giant hidden leverage event sitting underneath the system. So the choice becomes simple. Option 1. Sell and wait for safety. That feels responsible. Historically, it often means buying back later at higher prices after missing the strongest recovery days. Option 2. Hold and do nothing. Better than panic selling, but you miss the compounding advantage of buying discounted assets. Option 3. Keep investing. Keep your emergency fund intact. Do not invest money you need in the next 12 months. But for long-term money that was already meant to be invested, accept the discount and stay on schedule. That is the entire game. Because the first guy in 2009 was not careless. He was human. He trusted fear more than math. The second guy understood one thing that changed everything. The signal that feels like safety always arrives after the recovery has already started. In 2009, the bottom was March 9th. By June, the S&P had already recovered about 40% from the low. Investors who waited for confirmation still got back in eventually, but at far worse prices. Over a decade, that difference compounds into a radically different financial life. That is why these windows are rare. Not because the opportunity is hidden, because it is emotionally brutal. Extreme fear. Oil up 63% in a month. Tech down hard. Volatility exploding. Portfolios bleeding red. Those are the conditions that create the discounts. And the moment enough people believe recovery is coming, the cheap prices disappear. The 2009 window lasted roughly 3 months. The COVID window lasted weeks. This one, in the logic of the source script, is open right now. And 10 years from now, most people will not remember every headline. They will remember what they did. Whether they sold, whether they froze, or whether they kept buying when everyone else was waiting for permission. That is where wealth gets built. Not in certainty. Not in comfort. But in that narrow gap between what the data says and what your gut is begging you to do. The window is open. What you do with it is yours.